You know the exact feeling. It is 11 p.m., and you are lying in bed, staring at your phone screen, scrolling through like the latest real estate listings, looking at houses you cannot afford. You see a completely average, unimpressive three-bedroom house, nothing special. But then you look at the estimated monthly payment, and your stomach absolutely drops. You do the mental math. You think, if I stop eating out entirely, if I cancel all my subscriptions, maybe, just maybe, I can barely scrape by. You work 40 to 50 hours a week. You did everything society told you to do. Yet the math just does not add up, and the dream of owning a home feels like it is slipping further and further away every single month. It is exhausting. I mean, it really is. Most people think buying a house in 2026 is harder than you think because they just do not earn enough money, or because inflation ate their savings, or, because they buy too many coffees. That is the comforting lie the financial system wants you to believe. They want you to blame yourself. But the brutal reality is that you are struggling because the entire housing market has been fundamentally weaponized against the working class. You are broke because you have been programmed to buy massive liabilities that you incorrectly think are assets. The system is designed to turn your basic biological desire for shelter into like a lifelong contract of servitude. I'm Heisenbach, and on this channel, we break down the financial systems designed to keep you broke. In this video, I'm going to give you a complete real estate market update and show you the exact mathematical proof of what happens when you buy a house with high mortgage rates in today's twisted economy. We are going to expose the hidden traps waiting for the first-time homebuyer in 2026, and by the end of this, you will understand why renting versus buying a home might actually be the greatest wealth-building secret of our generation. This is not just another positive real estate video. This is the literal difference between financial freedom and a lifetime of making your local bank manager very, very rich. Let us start with the biggest lie currently circulating in the 2026 housing market forecast. Everyone is sitting on the sidelines, waiting for interest rates to miraculously drop back down to 3%. That is almost cute if it was not so financially tragic. I mean, right now, the major financial institutions and the Federal Reserve are signaling that rates are going to hover in the low 6% range for the foreseeable future. There is no magical rescue coming. But let us pretend, just for a second, that rates do drop to 5%. You know what happens next? Total market chaos. Every single desperate buyer who has been waiting in the wings will flood the market all at once. And when massive demand collides with a massive housing inventory shortage, prices explode upward. You end up paying $50,000 over asking price, completely wiping out any savings you got from a slightly lower interest rate. You cannot win a rigged game by playing by their rules. Let us do the brutal math, because frankly, the numbers do not care about your feelings. Imagine you're buying a totally average, somewhat depressing home. Let's say it costs $450,000. You manage to put down 20%, which is $90,000, in cash. Money you had to bleed for over the last 10 years. You take out a mortgage for the remaining $360,000. Let's say your interest rate is 6.5% on a standard 30-year fixed loan. Most people just look at the monthly payment. They think, $2,275 a month for principal and interest, I can swing that. But let's look at the amortization schedule. This is the multi-page document the bank slides across the desk very quickly, praying that you do not actually read it. In the very first year, you will pay roughly $23,000 just in interest. You are paying down almost zero principal. Your loan balance barely moves. Over the total life of that 30-year loan, you will pay $458,000 in interest alone. Let me repeat that so it sinks in. You are paying $458,000 in interest just to borrow $360,000. You are basically buying a house for yourself and a slightly nicer house for the bank executives. And that does not even include property taxes, home insurance, maintenance, or homeowners association fees. When you factor all of those hidden expenses in, that $450,000 house will cost you well over $1.2 million over 30 years. If you want to stop letting the banking system profit off your ignorance and learn how to actually build generational wealth, make sure to subscribe right now. Let us move on to the housing inventory shortage. There's a bizarre phenomenon happening right now that defies all traditional logic. For one of the first times in modern history, massive corporate home builders are actually slashing prices on new construction, while existing older homes remain ridiculously expensive. Why? It is because of the lock-in effect. Millions of homeowners refinanced in 2020 and 2021 at 2.8% or 3%. They are literally trapped in their own living rooms. They cannot afford to sell their house because buying a new one at a 6.5% rate would instantly double their monthly payment for the exact same quality of life. So, nobody is selling. The inventory of existing homes is bone dry. Meanwhile, big corporate home builders are sitting on massive neighborhoods of empty inventory they have to move to satisfy their shareholders. So they offer rate buydowns. They'll buy your mortgage rate down to 4.9% just to get you to sign the contract. But listen to me closely. This is a brilliant trap for the first-time homebuyer because you are paying a massive premium on the underlying purchase price to get that builder incentive. You are financing the discount they are giving you. It's a mathematical shell game, a classic bait and switch designed to extract your future wealth. Let us do some psychological analysis. Why do we keep willingly throwing our money into this financial meat grinder? It is because the American dream of home ownership has been deeply, methodically programmed into your subconscious since you were a child. You have been told that renting is throwing money away. You have been told that owning a home is the ultimate symbol of adulthood, of stability, of finally making it in the world. It is brilliant marketing by the banking industry. Truly brilliant. When you buy a house, your brain gets a massive hit of dopamine. You get to post the picture on social media holding the keys. You get the immediate status elevation among your peers. But humans are terrible at long-term risk assessment. We are driven by the intense fear of missing out. The panic in the housing market is weaponized to make you sign a 30-year contract that heavily favors the lender. You are trading 30 years of your future labor, 30 years of your physical and mental energy for a box of wood and drywall, just to impress people who do not actually care about your financial well-being. This brings us to the ultimate taboo, the real debate of renting versus buying a home. If I tell you to rent, people get furiously angry. They type in the comments, "Heisenbank, if I rent, I am just paying my landlord's mortgage." Okay. Let us look at the brutal math one more time. In almost every major metropolitan area right now, the absolute cost to buy a house with high mortgage rates is significantly higher than the cost to rent the exact same house. Let's say renting that $450,000 house costs you $2,000 a month. Buying it, when you include taxes, insurance, and the hidden cost of maintenance, costs you $3,500 a month. That's a hard difference of $1,500 every single month. If you rent and you have the discipline to take that $1,500 difference and you invest it into a basic index fund, getting an average historical return of 8%, over 30 years, that invested difference grows to over $2.2 million. Over $2 million. Liquid, accessible cash. While the prideful homeowner is stuck with a deteriorating structure that requires constant repairs, a new roof, a new air conditioning system, and property taxes that go up every single year, you, the renter, have quietly built a multi-million-dollar liquid fortune. Renting is not throwing money away. Renting is buying flexibility. Renting is buying a fixed cost of living so that you can deploy your heavy capital into true wealth-generating assets. We need to talk about equity, because this is the last defense of the uninformed. People defend buying a house in a bad market by saying, well, at least I am building equity. Equity in a primary residence is the most illiquid, dangerous form of wealth you can possibly hold. Let us say your house magically goes up in value by $100,000. Great. How do you buy groceries with that? How do you invest that in a new business venture? You cannot unless you sell the house and pay 6% in realtor commissions, plus massive closing costs, plus moving expenses. Or you go back to the bank on your hands and knees, take out a home equity line of credit, and go even further into debt. You see, your primary residence is not an asset. An asset puts money in your pocket every single month. A liability takes money out of your pocket every single month. Your house takes money out of your pocket every month for 30 years. It is a lifestyle consumption item. And in 2026, with inflation continuously eating your purchasing power and national home prices projected to stall at 0% growth, tying up all your liquid capital in a single, unmovable liability is mathematical suicide. We are entering a new economic era where geographic mobility is absolute power. The person renting can break a lease and move to where the massive opportunities are. The homeowner is anchored to a sinking ship, praying for the local market to save them. So, where does this leave you? I am not saying you should never ever buy a house, but you need a fundamental philosophical shift. You need to pull yourself out of survival mode and step into empowerment. Do not buy a house because society tells you it is the next logical step in life. Do not buy a house because you are terrified of getting priced out forever. That is fear-based decision-making, and fear will always, always make you poor. Buy a house only when the math makes absolute sense for your specific, personal situation. Buy a house when you have the cash reserves to avoid catastrophic interest payments. Buy a house when it is a conscious, calculated luxury, not a desperate, panicked grasp at a dying American dream. The financial system is rigid. It is cold. It is purely mathematical. If you want to survive and build real wealth, you have to be colder, and your math has to be better. I am Heisenbank. Class is dismissed.